Hello everyone. Today I'll be doing the general ledger of Kingfisher Enterprises. And the question is as follows. Kingfisher Enterprises is a local company selling computers and computer parts. All inventory sold at 35% markup on cost. The following transactions took place during May 2022 for Kingfisher Enterprises. Ignore VAT. As I said, it's the general ledger that we will be doing. And then we're going to start off with number one. We purchased in trading inventory from Bengaluru bargains on credit, 56,438. So I had already inserted the information when it comes to number one. So we have inventory in account in our debit side. Inventory will be debited. Accounts payable will be credited. So we purchased trading inventory on credit, meaning that our trading inventory is going to increase. So in our assets or inventories and assets, we're going to say plus 56,438. Okay, I'll just keep it like that. It's okay. Then in our liabilities, because accounts payable is a liability, it's 56,438. So that's how it is. Okay, I can also just do this. You guys can look at what I do for if you guys just want to make sure that your things look perfect. What's your understanding? Okay, sorry about that. My battery is low. Better. And then question 2, we paid monthly rent of 18,450 by electronic transfer. So in number 2, we have rent debited and bank credited. And our rent amounted to 18,450. So it's money going out, it's going to be a negative 18,450. Then our rent is an expense, so it's going to be 18,450 in equity. Yeah. Then number 3, we have sold goods on credit to Low Sean, 34,425. So that's 3. We sold goods on credit. So we have account receivable, and then we have sales, and then our accounts receivables is asset. So we sold goods on credit. It was 34,425. 34,425. It's a positive. Our sales is in equity, 34,425. There we go. Then we have our cost of sales and our inventory. So now to calculate our cost of sales, I'm going to do it here on the side. It's going to be 34,425 multiplied by let me just do this. It's 34,425 multiplied by, okay, our markup is 35% on cost. So what we have is the selling price. Let me do this. Yes, this is the selling price, not the cost price. So since we have the selling price, we're going to say what we want over what we have. So we want the cost price, which is 100%, divided by what we have. So our markup is 35%, and what we have is the selling price. So the selling price is the markup plus the cost price. So it's 100% plus 35%. So it's going to be 135. Right. So it's 100 over 135. So let me just expand this a little bit. So this gives you, I'm going to do it in Excel. So we have 34425 multiplied by, so the multiplication sign is a star, multiplied by 100, divide by 135, close the bracket. That gives us 25,500. So it's going to be a negative since this is stock going out. So inventory, as I said before, it's an asset. Our cost of sales is an equity, 25,500. Then we move to number 4. The owner B. Bangalore made a capital contribution to increase his capital from 158,000 to 250,000. This was done by means of an electronic transfer from his personal account to the business's bank account. So increased his capital from 158,000 to 250,000. So for number 4, we're going to have bank, because the money came into our bank, and then we have capital. So this is his capital, it will increase. So capital is an equity. So most of the equities, they increase on the credit side, unless maybe it's an income. Uh, Incomes, they increase in the credit side, whereas expenses increase in the debit side. Then your assets increase in the debit side, your liabilities increase in the credit side. You see. So in regards to this question, we're going to say 250,000 minus 158,000. So it's 250,000 minus 158,000. What did I want to do? Yes, number. So the answer here will be 250,000 minus 158,000 gives us. Hey, why does it do that? Okay, it's not supposed to be there. Oh, okay, it's 250,000 minus 158,000. That gives you 92,000. So the bank will increase by 92,000, and his capital will increase by 92,000. So as you can see, guys, when it's a positive, it does not add a plus. So the ones with no negative signs, it's where the money increases. Then as we move on, we have at number 5, we paid wages 9,840. This was done by drawing cash from the business's bank account. So it's 9,840. So at number 5, we have wages and bank. And with wages and bank, it was 9,840. 9,840 is a negative because money is going out. 9,840. Wages is also negative. 9,840. There we go. The reason being it's a negative, it's because our equities are equals to our liabilities. So if we were to put this in a math equation, it would be 9,840 is equals to 9840 plus 0. So in order for this to be equals to this, when you transfer this 9840, you're going to say 9840 minus 9840 gives you 0. You see, so which is why it's a negative and a negative. Okay, we don't need a calculation here. Yeah, better. Then on transaction 6, we have received an invoice for repairing the printer, 3,981. The invoice was done by the electronics transfer. It is company policy that repairs are not capitalized. See? So here it's day 6. So it's invoice for the printer. So the printer falls under our equipment. And then we have bank, and our equipment is an asset. So what we're going to have is our equipment is going to increase by 3,981, 3,981. Then our bank, I'm not sure how to do this one actually. Let me see, it's going to be negative 39. Oh, yes, a negative 3,981. I'll just add another row here. Yeah. Okay, this is okay. So with this one, it's a bit difficult. Reason being, I'm using Excel, and equipment and bank are both assets. You see, so as equipment increases by 3,981, assets decreases by 3,981. So this is the bank, this is equipment. So let me just do this. That's the bank, not the font. I've been trying to highlight this. I'm sure that I'm failing. Okay, so this is the bank amount, because they are both assets. So the one asset increases, the equipment increases, but the bank decreases. So then we have number 7, cash sales 12,015. The amount was banked on the same day. So it's number 7. We're going to do the same thing that we did as at number 3. The only difference is that instead of account receivables, we're going to have bank and then sales. And the amount was 12,015. 12015. Bank is an asset. We all know that. 12015. As I said, sales is an equity. Then we have cost of sales and inventory. So this one we're going to calculate again. We have 12,015 multiply by 100 divide by 135. Okay, this one, let me just do this. Put it as a general. 100 divided by 135. And this will give you equals to 12015 multiply by 100 divided by 135. Close the bracket. This gives you 8,900. So our cost of sales is 8,900. So here we're going to have a negative 8,900. And then in our equity, we have a negative 8,900 because stock went out. Here money came in, here stock went out. Then transaction 8, it says we purchased a computer for use in the office on credit, 15,999. So on the 8th transaction, we have equipment. Our computer falls under equipment. And on credit, it's account payable. So it says that we purchased it for 15,999. So it's our equipment increased by positive 15,999. Now accounts payable 15,999. So before I continue, guys, I need to make something clear. So with our accounts payable, that is our creditors control. Accounts receivable, that is our debtors control. So we have accounts payable, which is equivalent to, which is our creditors control. Then accounts receivable, that is our debtors control. Let me just do this. Okay. So how do I know if a transaction requires the creditors control or debtors control, otherwise known as account payable or accounts receivables? So when we go back to our questions, anything that's on credit does not go to the bank. Remember that whenever we buy or purchase or sell stuff, the money goes to a bank. But if it's on credit, it does not go to your bank. So if you're buying from credit, remember that when you buy from credit, that means that you owe this person. Those are our creditors. We owe our creditors. And that's our accounts payable. That's the account that we have to pay because we bought on credit. But now if we sell on credit, those people now owe us. We don't owe them, they owe us. And those people who owe us are known as our accounts receivable because we're receiving or we're going to receive the money in future. Also known as our debtors control. So if you look at all these transactions, all of the ones where we said accounts payable or accounts receivable, they have credit here. So it goes on credit. See, look at that word, credit. Where's the next one? Credit, see, credit. But now if it says electronic transfer, it's like your EFT, your bank transfers. Your bank transfers, that means that you're paying money from your bank account. So it's coming directly from your bank account. It's affecting your bank account. It's not going to be a future payment. Yes, it may not reflect today, but on the person's account or on your account, but the money did go through. It's like when sending money to your friend. When you send money to your friend, you can send them 500, and because of the bank delay, it may take 2 to 3 days to reflect on their account. But on your account, the same time you press send, the money's gone. Maybe it's floating around, still traveling, catching a bus to your friend's account. But in the moment you send the money is gone. So that's how we know if we're going to use accounts payable or accounts credibles, or we're going to use bank. So at bank, it's electronic transfers and cash transfers. Okay, unless maybe they specifically state petty cash. Usually they'll say that we took money from the petty cash. Then yeah, we won't use bank, we'll use petty cash. And petty cash is the money that we have on hand usually. Like if you run a store, your petty cash will be the money at the till. So okay, we had transaction number 9. So with transaction number 9, it says received payment from a debtor, 2,500 as part on his account. So on number 9, we receive so it's going to be bank, and we have accounts receivable. So now let me explain this one. This debtor paid us. So meaning that the money that he owes us, whatever money that he owes us, it went low, which is why we have bank and accounts receivable. So they are both assets. So look at this. He paid how much? He paid 2,500 as part of his account. So our bank, we got money into our bank, 2,500. That's money that came into our bank. Let me do this. Entire row. Let me just add another one just in case. So that's money that came into our bank. But because now he's paying his debt, the balance of the people that owe us money is decreasing. The balance of the people that owe us money is decreasing. So if 5 people owed us 15,000 rand, it just decreased by 2,500 because one person decided to pay. So that is our accounts receivables. You see, our bank increased because we got money into our bank, but the people that owe us decreased. Our debtors control decreased by 2,500. Yet we have money in our bank account that is 2,500 that we got. So I'm going to do the same as I did here and highlight it to show that this accounts receivables is this amount here, and here I did show that this bank account is this negative amount here, the 3,981. So now the next thing that we have is transaction 10. The owner took 500 from the petty cash for personal use. So the petty cash is not bank. The petty cash is really the small amount of change that you have on hand. So he took money from petty cash. So this is drawings. So we're going to have drawings and petty cash. This is money that went out. And the money was, 500 rand. So we're going to have a negative 500 rand because remember petty cash is also an asset. So assets decrease on the credit side. So we have a negative 500 rand, and drawings is an equity, it's a negative 500 rand. So guys, if you look at this, this tells you, so where you're going to write your accounts payables. If your accounts payables is in your credit, then you already know that it's a positive number. If I wrote accounts payable in my debit side, accounts payables in the debit side, it decreases. So it's going to be a negative number. So the only confusing part is equity. Equity is your capital, which is debit is a negative, credit is a positive. And then it has income and expenses. So anything categorized under income on the debit side, it decreases. On the credit side, it increases. But anything declared as an expense on the debit side, it increases. On the credit side, it decreases. So an expense is similar to an asset. I'll try to show you something. So you see here, guys. No, why we adding? Why are we adding? We are not supposed to be adding. We're supposed to be explaining. So here, this is a rent expense. So rent expense is an expense. Okay, it's in the name. But because rent expense is an expense, as I said, expenses on the debit side, they increase. On the credit side, they decrease. But then if you look at this on the debit side, here's our expense. See, money went out. But then we're using bank because bank money went out from our bank account. So it's a negative money. And then rent is also negative because they have to be equal. But then if we had a rent income, someone paid rent to us, then our bank would be on our debit side, our rent would be on our credit side. Then we know that it's rent income. So when it's like that, these amounts would have been positive. See, so yeah, let me move on, guys. We have the last transaction number 11. Number 11. So in number 11 says settle the account of Bangalore bargains in full. No discount is allowed, and the balance on this account at the beginning of the month was 2,780, being an amount short paid in April 2022. So we are going to settle an account of who is it? Bengaluru. This is the people, this is our creditor, the person that we owe. We're going to pay them in full. So we're going to have transaction number 11, accounts payable, because we're paying the account, our account basically. The money that we owe them, and then the money that we're paying them is from our bank account. So we can't pay them with debtors or our accounts receivable. I mean, those are people who owe us. How do you pay someone with someone that owes you? So it's money straight from a bank account. So this one is a calculation. So we have the opening balance of 2,780. So it's 2,780. And then we move on. So we purchase trading inventory from Bengaluru on credit, which is the 56,438. So we say plus the money that we used to purchase. My tongue. 56,438. And then, okay, this is Bangalore. Okay, this is weird. How can our owner be P Bangalore yet we owe P Bangalore? Crazy, right? So we look for anything related to this company here. So we do not have anything else. So it's just those two. We only have our opening balance and the purchase that we had made during the year. So we're going to add the two. No, man. So we add the two. And they are equals to 59,218. So we have a negative 59,208 because money is going out of our bank account, and a negative 59,218 because the people that we owe are now decreasing. Just say this, they are now decreasing the people that we owe. So as I said, guys, your account payable is our creditors control, accounts receivable is our debtors control. Then calculating our cost of sales, we have the amount, our selling price. This is our selling price multiplied by what we want over what we have. So always, guys, you need to understand this. I'll make an example here. I'm sure I've done it in one of my other videos, I'm not sure. So if we have a selling price, our selling price is equals to our markup plus, okay, let me basically do this. So we have a cost price which is always equals to 100. Then we have our markup. So this is our, the profit. So it's going to be markup or profit. And this is equals to, let's say our markup is 25%. So our selling price is always equals to our cost price plus our markup. So that's 125. So if we had goods, if we sold goods on selling price at 100,000 rand, we were going to have 100,000 multiplied by what we want. So we're looking for a cost price, which is 100, divided by what we have. So we have the selling price, 125. And this one is equals to 100,000 multiplied by what we want, divided by what we have. That gives us 74,000. No, it's 25%. Hey, yes, that gives us 80,000. This is if we have the selling price. So now if we have the cost price, and you're looking, and the cost price, here's our cost price, 80,000. So, okay, I'll say this is our CP. This is how we got our cost price. And then now, let's say we're looking for a markup. So we're going to say what we want, which is 25, divided by what we have, 100, because we have 100. This equals to 80,000 multiplied by what we want, divided by what we have. That gives us 20,000. See? So let's say maybe we have our markup or profit, and our markup is 20,000. So this is our markup profit, and we're looking for our selling price. So we're going to say what we want over what we have. So we're going to say 125, because we're looking for our selling price, and our selling price is 125 here it is here. Over what we have our markup of 25%. See, so it's going to be 125 over 25, and this one is equals to 20,000 125 divided by 25. That gives us 100,000. See, here's our selling price, 100,000. Here we are, selling price 100,000. So it's basically the same thing, guys. I can play around with this markup, and then if I'm looking for my cost price, I'm just going to say 20,000 times what I want, which is 100, because of my cost price is 100, divided by what I have, 25, and this is equals to, then open bracket, 100 divided by 25, close the bracket. Hey, why is it 400,000? Oh, it's not supposed to be 100, it's supposed to be 20,000, because it's see, 20,000 times 100. It's supposed to be an equation, 80,000. We've got the cost price at 80,000. So you can do this. However, it's just what you want. So if you're looking for the cost price, it's going to be 100, because you're looking for 100 over what you have. And if what you have is a markup, it's going to be the markup 25%, or whatever percentage you're given. So that's how I calculated my cost price, and that's the formula that you guys need to know off by head. For me, I crammed it as what you want over what you have. And guys, that's going to be it for today's video. Hopefully I gave you guys some good information that may help, and I hope you enjoyed the video. Thank you very much, and